Well, holy smokers, folks, we have two very large companies that just hit 52-week lows here today that I want to go ahead and I want to talk about in this video here today. And I want to give my perspective on these two particular stocks and if I feel these stocks are buys. Now, these stocks are both very, very popular, needless to say, in the stock market. So, yeah, I think a lot of you guys have either owned these stocks or you've thought about owning them over time, and so I thought it'd be relevant to give my opinion on this. So hope you guys enjoyed today's video. As always, that's all I got for an intro for you here today. Don't forget to smash that like button. That helps out huge in the YouTube algorithm. I appreciate all you guys for being here, and that lets me know you guys enjoy a video like this where we get into some stocks that just hit 52-week lows. If you guys like videos like this, I could do more of these types of videos in the future, especially in a downtrending market. Let me know, and if I see enough comments, maybe I'll do it. Okay, so first one up here is Alibaba. This one closes at $139.63 today, down over 3%. It hit its 52-week low literally in the trading day today, $138.43. Now, in regards to Alibaba, this is caught up in a whirlwind, which we're going to get into here. But needless to say, this isn't just a 52-week low. This is a multi-year low for Alibaba. This is a multi-year low for this stock. Literally, you have to go all the way back to 2018 to find Alibaba trading this low. Not even in the Rona crash was Alibaba stock this low. Baba has not been this low since 2018, and if it keeps dropping and it falls below 132, guess what? It will be even lower than it was back in 18. And keep in mind, that was a time period when the market was really rough and there was a lot of fears around US, China, blah, blah, blah. And so, yes, this is not only a 52-week low, but a multi-year low for Baba now at this point in time. Now, keep in mind, in regards to Alibaba, it's a Chinese company, and there's a lot of fear out of China right now. You have the Evergrande situation, Evergrande, whatever you want to call it, okay? It's bad over there, okay? I mean, you're seeing stuff like this. Evergrande offloads property management wing in the latest attempt to stay afloat. Basically, this Evergrande's trying to do everything possible to stay afloat with their $300 billion roughly in debt. And there's such a risk of contagion of this taking down the whole Chinese market, the Chinese real estate market, and being something they have to take some years to work through. That's the big fear. It's like, is this something they can slide past, or is this more like something that will devastate the Chinese real estate market for several years? Because if that's the scenario, then you could be looking at a weaker Chinese economy in general, a weaker jobs market in China in general. And when you're talking about a situation like this, all of a sudden you talk about, oh man, maybe this could hurt a lot of companies, including a big beast like Alibaba. If all of a sudden China ends up in some sort of big recession and their market's devastated and the banking system dries up there for a period of time, this isn't like fake fears. This is real fears that I think, all investors have to take into account. And I think this is one of many reasons why Alibaba stock is trading now at a multi-year low. Now, if you look at Alibaba's business, I mean, you can't, what are you going to say bad about this business model? Look at the revenue over the past decade or so. Back in 2018, $978 million of revenue. Now they're doing $100 billion plus of revenue. Absolutely extraordinary growth over this past decade. There's no doubt about it. Alibaba is arguably the most relevant company in all of China. The most relevant company in all of China. They are a beast to be reckoned with, and they're one of the most relevant companies in the world, period. Okay? It's an extraordinary corporation. Look at the net income. From losses back in 2010 to 20 billion plus of net income now. So you're looking at a company that's revenues have gone insane over the past decade. The profits, the net income have gone insane over the past decade. I mean, right off the bat, this is a type of stock I absolutely love. And they're in a lot of needs-based businesses as well. It's not like if, the economy tanks, like their business is done. Like a lot of what their products and services are, they're needs-based at the end of the day. And so things have been looking great. And I mean, things look like they're going to continue to be great. If you look at the EPS, this company expected to grow from $9.35 to $10.89. That's 36 analysts are covering this stock. So it's not like it's a small group, right? 42 analysts cover it from the revenue side. 27% revenue growth expected this year. Another 20% roughly expected next year, and that's 42 analysts covering this. Next year they're expected to do $168 billion of revenue, and that's 42 analysts that are covering this stock. So let's get this right. Alibaba's business model, amazing. Alibaba's revenue growth the past decade, amazing. Alibaba's net income growth the past decade, amazing. Alibaba's expected growth over the next year or two, amazing. Everything, amazing, okay? But at the end of the day, why have I not bought this stock yet, right? And I'll tell you what I'm thinking about doing in regards to stock in just a moment. But why haven't I bought it? Well, at the end of the day, Alibaba is an ADR out of the Cayman Islands. And this is, something that I've always worried about in regards to Chinese stocks in general. And I think all investors should at least take into account. And when you have the Chinese government acting very suspect, let's just call it that, it's not a very good situation when you're buying Alibaba, which is you're buying an ADR out of the Cayman Islands, right? Which is like the hope that essentially you own Alibaba. And when there's huge trust issues right now between China and basically everybody else in the world, and especially investors in China, right? When you have that sort of situation and you're not even really technically buying the company, it's going to lead to more and more trust issues. Now, there's an easy way to fix this overnight. They did this and the stock jumps 10% plus tomorrow, and I'm buying the stock and a lot of other people are buying the stock, okay? Pay out a dividend. Doesn't have to be a huge dividend. Just if Alibaba announced they're going to start paying a regular 3-month dividend, right? A quarterly dividend, that would change the game for the stock overnight, okay? Immediately, everybody would start trusting the stock at least a little bit, right? Everybody would start looking at it as like, oh, at least they're taking some of their profits and they're paying it out to us in the form of dividends to the shareholders. Right now, the shareholders get nothing, absolutely nothing. And when you're buying into an ADR out of the Cayman Islands, it makes you have even more trust issues, right? Literally, if they start paying out a portion of their profits in the form of dividends, even at a 1% dividend yield or something like that, the stock price goes up 10% plus tomorrow, and I would have a lot more trust in Alibaba, and I can tell you countless other big fund managers and countless other investors in general would have an immense amount more of trust toward Alibaba literally overnight. Now, I will say, what's the realistic scenario this plays out? Extremely unrealistic. I don't think the Chinese government would even allow a company like Alibaba to pay out dividends to shareholders. If you notice, almost all the Chinese stocks, if not all the Chinese stocks, none of them ever pay out dividends to the shareholders, right? You look at Alibaba, you look at Baidu, you look at Tencent, you look at a ton of these companies, there's no dividends, right? And at the end of the day, I don't think, this next guy, I don't think he would allow these companies to pay out dividends to U.S. investors. And that's unfortunate. And if you wonder, how's Wynn get around it? Wynn, Las Vegas Sands, things like that. Well, they essentially have corporations that are set up as kind of like Macau corporations, Chinese corporations. And then from there, those companies will pay the money out to basically the parent company, which is Wynn Las Vegas, right? And so that's how those companies kind of get around it. But as far as a straight up Chinese company like an Alibaba paying a dividend to American investors, I don't think this guy would allow it, Xi Jinping. And it's unfortunate because what he has done is he's created such, distrust between investors in Chinese stocks, Chinese companies, and doing business in China that it's going to end up hurting his market for quite a while. And ultimately, it hurts the global economy. If this man changed his stance and all of a sudden became a little more friendly, just a little more business friendly, a little more friendly to Alibaba and the other big guys, a little more friendly to the Macau situation, a little more friendly just in general to business, I can tell you, Alibaba is a $200 or $300 stock. But at the end of the day, with this man and the way his stance is, it's hard to see that stock at $200, $300, $400. This should, honestly, if Alibaba was fairly valued, this would be a $300 plus stock today. But at the end of the day, folks like myself and a ton of other folks don't want to invest in the stock because of this man right here and his unfriendly business practices, and it seems like it's getting worse over there. And so a lot of us are looking at it and like, okay, we see a bunch of U.S. stocks falling. We see small caps trading cheap. We see mid caps trading cheap. Where are we going to put our money? In ADRs out of the Cayman Islands with Mr. Unfriendly? potentially, who knows what he's going to do next, right? Or are we going to go ahead and buy smalls and mids that are U.S. based that we know are much safer for the long term, right? And so think about it from that context. If this man's changed his stance, this stock's a huge moneymaker. I mean, a huge moneymaker. Now, one thing I'm considering with Alibaba, even though I don't want to buy the shares because of all the massive amount of trust issues, I have contemplated buying a smaller position in like call options, right? So it's either I could buy, let's say, $100,000 worth of stock straight up, or I could buy like $20,000 worth of call options in Alibaba, or $10,000. And so I've considered doing this recently at like a 140 strike, maybe paying $40 some for it, and maybe if it fell a bunch more. And the reason being is Alibaba's in one of those situations where the stock's either going to likely beast over the next couple of years and go up massively, or it's going to likely tank a lot harder because the trust issues from Xi Jinping and folks will get worse and worse and worse, right? And the stock price will fall more and more and more. And so when I look at it, I say I could risk 100K in the stock straight up, and that 100K can become 70K, 60K, 50K. Or it could become 150K, right, or 200K, or it can risk 10,000 or 20,000, and that 10,000, 20,000 ends up growing into 40,000, 60,000, 80,000, or I just lose 100% of it, right? And so for me, for a risk-reward standpoint, for Alibaba, I'm actually considering calls on the stock in a smaller position rather than buying a bunch of shares of stock. And like I said, man, if this guy changes his stance and becomes a lot more business-friendly, stock-friendly, Alibaba would be looking at being a B stock. But, man, as long as he's unfriendly, it's going to be tough sledding there, okay? So, Alibaba, love the fundamentals, but don't love the man that's really controlling the stock right now, okay? Zoom ZM. This is the other big growth stock that is at 52-week lows. Today it hit 253.41. That is its 52-week low on this stock. A lot of you guys probably know Zoom because if you have a business or if you do any business, you probably had some Zoom calls over the past 18 to 24 months. Zoom came out of nowhere, has grown into a beast company. But let's be quite frank. Around this time last year, the stock's trading at $568. And today it's at $259. That's over a 50% fall in Zoom stock in a matter of less than 1 year. The fall from grace has been extraordinary for Zoom stock, needless to say. I mean, absolutely insane. Some really good news in regards to Zoom stock is the valuations have come down dramatically over the past year. You look at the stock a year ago, right? I mean, it was downright scary. October 31st, Halloween last year, it was downright scary. 583 trailing PE versus an 84 trailing PE. Okay, now we're talking, right? Now, Zoom, because it's a big growth stock and because it's kind of seen as a B2B play, and almost, some people almost kind of put this into like a SaaS business model, even though it's not really SaaS, but they kind of almost value it that way. It's always going to likely trade at a much richer valuation in the market, right? So it's still trading pretty dang rich. There's a big difference between a 583 trailing P and an 84, right? Forward P, it was at 140 last year in October, right? Now it's at a 61 forward P. PEG ratio, 2.1, now 3.1. And as far as price to sales ratio, this is another big one I look at when it comes to growth stocks. Over 100 price to sales ratio at this time last year versus 23. Now, keep in mind, a 23 is still darn rich for a price to sales ratio, but a huge difference between 100 and a 23, okay, in terms of price to sales ratio. So the good news is Zoom stock's valuation has gotten a lot more compelling. And this has me actually somewhat looking at the stock now and saying maybe there's something here in regards to Zoom. Now, next up, we go ahead and we look at its growth. And as far as EPS growth, this is worrisome. So 334 to 484, that'd be great. But look at this, guys. Look at this. Expected to have no EPS growth next year. That is troubling. You don't want to see something like that in regards to a growth stock. No, maybe analysts have it wrong, and maybe Zoom is going to grow, and they do a $5.50 number, a $6 number, or something like that. And that would be extraordinary. But as of right now, that's definitely worrisome and something that somebody like myself that's on the sideline in regards to stock is looking at and like, wait, why are they not going to have EPS grow next year? Because in a growth stock, you want to see revenue growth, but also you love to see EPS growth as well, right? The company either getting to profitability or to more and more profitability. And so that's definitely worrisome there. Now, revenue growth-wise, extraordinary. 50% plus expected this year. Next year, 17% plus revenue growth expected. So that is a thumbs up. That's really, really good there. Now, here's the issue with Zoom stock. I'm looking at the numbers, and other than EPS, it looks really, really impressive. You look at the revenue over the past few years. You look at how relevant the company is, right? No one ever heard of Zoom 2 years ago, and now everybody knows Zoom that's in business. And so that's great, and they're kind of got almost that Kleenex, right? You ask for a tissue, you ask for a Kleenex. If most folks go to a restaurant or a bar and they want a soda, right? Like a cola, they ask for a Coke. And so that's great when you kind of have that brand name here. The main issue is this just a one-trick pony? Is Zoom stock just a one-trick pony in the end, and all they are is a video communication company for businesses? Because if that's the situation and they're only truly a one-trick pony, then that's a little troublesome. And so when I'm diving into this company over the next week or two, I've got to find the belief that Zoom can be a lot more and is becoming a lot more than just a video communications company. Because if that's all they are, it doesn't interest me that much. Now, this company tried to buy out Five9 very recently, and this deal just got shot down, okay? It was a $14.7 billion deal, which was crazy big for Zoom, essentially. And this was supposed to be an all-stock transaction, but unfortunately for Zoom, its stock price has lost more than a quarter of its value since they announced the acquisition. Usually when a company is bought, shareholders receive a premium over their stock price. Because this was an all-stock deal, however, Zoom would be picking up Five9 at a discount, obviously. And so this deal, boom, destroyed. And this was something that was supposed to help Zoom become, even a stickier business model and even a better business model. And so now I'm looking at this, and part of me is kind of like, maybe Zoom was going to bite off too much than they could chew in this situation, because this was a huge deal and it was going to cause massive dilution of Zoom. And so maybe they're better off with this deal, or maybe this just sticks them more in a situation where this stock is just a one-trick pony in the end. And once again, if they're a one-trick pony, in regards to this, it's not that dang attractive of a stock if it's just a one-trick pony. So I've always felt like, I always thought, like, if you want to really become a massive giant to compete with Mr. Softy, if they combine Slack, Dropbox, and Zoom together, man, that would be powerful, because you get the cloud business, e-signing of documents, with overall business communication and the video communication portion. If these three companies combine and merged, man, I could tell you they could put up a solid fight against Google McDougal and Microsoft in regards to on the business to business front, right? And keep in mind, Microsoft and Google are involved in a lot of other businesses as well. But at least for the B2B side, if these three combined, they would be a force to be reckoned with. Now, unfortunately, I don't think a deal like that will ever happen, but man, I could tell you that would make a lot of dang sense. And so at the end of the day, when it comes to Zoom, I got to figure out, is this just literally just a video conferencing company, a FaceTime, but for business owners? Is this just FaceTime for business owners? That's what I'm trying to figure out. And for people that are involved in business, or is this going to become something a lot more over the coming years? So yeah, hope you guys enjoyed this video. As always, let me know if you enjoy a video like this where we discuss some stocks that are hitting 52-week lows and me giving my perspective on it. If you would have ever been interested in my private stock group, we have a 7-day free trial going on right now. That will be the pinned comment down there. Much love as always, guys, and have a great day.